Are we setting up for the biggest bull trap of all time? Stock market bears will tell you that the market shouldn't be going up this much with bank failure after bank failure. Obviously, we have the debt ceiling crisis as of the time of this recording, still not resolved. We have the fastest rate hikes in history. Inflation is still nowhere near the 2% goal. And the stock market right now is at the 4,200 psychological resistance level. So why is the stock market going up? Well, in this video, I'm going to break it down for you, and I'm going to tell you whether I think the stock market is in a bull trap or not. We're going to take a look, obviously, at the chart. Here's what else to expect from the video. We're going to take a look at the credit conditions. This is way more important than you think because right now the credit conditions are as tight as they were before the 2020 recession, the 2008 recession, the 2000 recession, and the 1990 recession. The probability of a recession now stands at almost 100%. So we're going to go into this indicator and whether the history of this indicator has been accurate. And then towards the end of the video, I will be telling you how I'm positioning myself from a market perspective, what I'm doing in my portfolio in order to take advantage of the fears that are going on right now, especially with the debt ceiling crisis, but how I'm looking to play this extremely tricky economic and financial landscape. So without further ado, let's get right into it. First, I'm going to start off with the S&P 500 chart. Again, if you follow this channel, you know that we've been tracking this channel, pun intended, from the 3,800 to the 4,200 level. And I said, and I keep saying time and time again, for me, there is no reason to decline yet. Now, it doesn't mean that there won't be, but think about this. The stock market is all about earnings. All the stock market cares about is earnings. If earnings show that companies are not doing as bad as the market thought they would by Q2 of 2023, then the stock market is actually going to keep going up or at least trade within the highs of this channel, right? So when you have stock market bears screaming, why is the market not tanking? Simple answer is because the stock market at the end of the day only cares about earnings. Now, I do think that there are some concerning things on the horizon, which we will get into here. But in my view, in order to get above 4,200 or below 3,800, there has to be a massive event. To get below 3,800, I believe there has to be a black swan type of event or maybe a gray swan type of event that likely has to do with corporate credit or consumer credit or both, some type of credit event. Now, some argue that the bank runs would have been that type of event, but we know that the Treasury and the Fed came in to backstop those bank runs. So in this case, it will likely have to be in the corporate or consumer or both credit sector. And I'll talk about credit events in a second or potential credit events in a second. But that is to get below 3,800. To get above 4,200, I believe what needs to happen is two things in the short term. One, a resolution on the debt limit well before the June 1st X date. And right now I'm recording this on May 21st. And two, a pause in interest rates on June 14th. Now, what's tricky about that is June 13th, CPI comes out. So I'll talk more about that in a second as well. But that is my summary of the levels in the S&P 500. Now, again, as I said towards the end of the video, I'm going to tell you how I'm positioning myself more swing or long-term plays. But in the interim, I still think that day trading is the best tool in this market, not swing trading. I think that swing trading has killed a lot of traders. Think of all of the traders, for instance, who were short NVIDIA, and it wasn't just retail. There were institutions that were short NVIDIA just based on the numbers, and those traders lost billions of dollars in NVIDIA shorts. Same thing with Apple, for instance, right? The market is clearly penalizing people for trying to hold short swings in this case, right? And even the S&P 500, it has been trading range bound, but stock market bears believe that the S&P should be tanking heavily right now, so they position themselves heavily in shorts. So I believe that day trading is the best way to get around the day-to-day in the market, not holding positions overnight. We day trade every single day in the Traveling Trader Academy. For those of you in the Academy, you already know I value quality over quantity. I actually don't trade that much. I take maybe one trade a day maximum. And I don't trade every single day either. However, the trades that we take are high quality setups. We've had one losing trade in the last 10 trades. Those of you in the Academy can verify this in the comment section. All that is to say, we now have monthly memberships to the trade alerts and analysis. We are almost capped and we are going to be closing those soon. So if you wanted to take advantage of monthly memberships, click the link in the description below. All right, so that is the chart. Here's what I wanted to talk about in terms of what is concerning, okay? Because to me, not everything is concerning. Obviously inflation coming down heavily, and the fact that PPI leads CPI, and the fact that PPI came in lower than expected. I do expect CPI to keep falling, although it might take a while to get to 2%. And I will talk about the history of, when inflation was around this 5% area, how long it took to get down to a 2% target. But the one thing that's concerning here is a credit crunch. And I've talked about a credit crunch before. And in layman's terms, a credit crunch basically just means the inavailability of credit due to banks tightening their lending standards, right? So because of all of the bank failures, banks have now, and because of the rate hikes, et cetera, banks now are taking much less risks. And when banks take less risks, there is less availability of credit on the market. And that usually causes mayhem to the economy, because our economy largely depends on credit, not only the consumer economy, but the corporate and small business economy as well. So every time that we have been at this level, so we can draw a line where we are right now. And if you draw a line and go back, you can see that every time we hit this level on the credit crunch, or the net percentage of domestic banks tightening standards, which is what the Fed calls it, but basically fancy speak for a credit crunch, we have hit a recession. And if we take a look at this recession probability chart by Haver Analytics, this is one of the most accurate recession indicators that we have. Every time we've hit this level near 100%, currently we're at 99.3, we've had a recession. We hit near this level in 75 and in 80. And for all future recessions, we haven't even had to hit near 100% to get to a recession, but you do see the spike here that takes us to around the 90% mark. But this is basically a model that calculates the difference between the 3-month forward treasury rate beginning 18 months ahead and the current 3-month treasury rate. We've also had the biggest 2-week decline in bank lending, and this usually results in a recession as well. Now, it's funny because if you take a look at these recessions, 1990, 2001, 2008, and now, or the possibility of having a recession now, every single picture looks different from an unemployment and inflation standpoint. I'm not even talking about GDP here, but either unemployment was high and inflation wasn't, or inflation was high and unemployment wasn't. Really, the only time that kind of mimics what we have now in terms of inflation was 1990. And in 1990, unemployment was higher than it is now, much higher. But inflation was around where we are now at 5.4%. So what had to happen is the Fed had to keep rates higher for longer. They did enact some cuts because unemployment was just going crazy. But even after the cuts, right, and unemployment was high, which is what the Fed is trying to achieve now, even after the cuts, it took, it went from 5.4% in 1990 to 4.2% in 91. So in a full year, it dropped, 1.2 percentage points. And then to 3% in 1992. So another year to take it down a percentage point. So the point I'm trying to make is, when inflation is over 9%, that is such a high mark that you tend to see faster progress in terms of a decline. But then once you get to 5%, the declines are very incremental. And that is historically as well, with the best example, or the best latest example, coming in 1990. So it wasn't until 1994 that inflation got to around 2.5%. So it really took the economy almost 4 years, or not the economy, inflation almost 4 years to get from just above 5% to just above 2%, right? And this is with unemployment already being high, meaning spending wasn't a factor as it is now, because we have unemployment is super low, historically low, that spending is still very high, which is what is likely to keep the prices up. So, there are tons of conflicting signals here. And for me, as I said, I'm going to tell you how I'm going to be positioned. But for me, I don't see a significant reason to buy the market here. I don't see a significant reason for a market incline or a market decline yet. I do think it will rear its head, and we will likely see a more clear sign of either a huge recession, or a huge reason for a recession, or not, right? And I know that that kind of sounds like, oh, the market can either go up or down, but it really isn't. I'm saying that I'm not overly bullish and I'm not overly bearish, and I do definitely prefer to day trade. I do think that the stock market can make it to the 4,300 to 4,500 range on the S&P 500 if we get two events that happen relatively quickly back to back: a debt ceiling raise and an agreement on the debt ceiling that doesn't take us to the brink like we saw in 2011, and a FOMC pause, right? However, speaking of the pause, yet another data point that we have to bring up here. If those two things happen relatively quickly, I do think that the market can go incrementally higher in the short term, right? However, really depending on when the debt ceiling issue is resolved, because I want you to remember something regarding the debt ceiling, right? In 2011, the debt ceiling fell after the agreement was passed in 2011, right? So if you take a look at the timeline, it says in 2011, stocks started cratering in late July, about 10 days before the August 2nd X date. Right now, the X date for this timeline is June 1st, keep in mind, and continued falling until President Barack Obama and Republicans announced a deal on July 31st. So this was 3 days before the August 2nd X date, and stocks started dropping. However, it says the carnage didn't stop there. 2 days after Obama signed the debt ceiling, the stock market reported its worst loss since the financial crisis, as traders absorbed how the agreement would hit an economy that was still stuck in the mud. So in this case, it really depends, I think, on what is agreed to, what cuts are agreed to, and also how long the two parties are willing to keep this issue unresolved, right? How long they're willing to take this to the brink. And the fact that we're at 4,200 now, as they say, when technicals intersect with the news, in this case, we're at the 4,200 psychological resistance level. When that intersects with the news, that creates a perfect storm. So, if in the following week, as of the time of this recording, they are just far away from a deal, then I do expect the market to start dropping. And if they do announce a deal, it really depends on what they're going to be cutting in spending. That can definitely take the market down further. However, if the deal sounds favorable and they get it done within a relatively short amount of time, I do think that we could get to 4,300. And if the Fed actually pauses in June, remember CPI comes out 1 day before FOMC, then I do think we can get to that 4,400, 4,500 range. But I don't think the story on credit conditions is done yet. I think that this will start wreaking havoc on the market. I don't think that inflation is going to come down that quick. Again, the best example that we have is 1990, when inflation was at 5.4%. I will leave this article in the description from The Balance. It's the best article I've ever read on the Fed funds rate, unemployment, and GDP historically for the United States. Now, in terms of how I'm positioning myself, check out this video I did here on how to buy bonds. Now, why bonds, you ask? Well, the reason is because you will likely not see these rates again. The 1 month is paying 5.7% almost. The 2 month is paying, 5.3% almost. Same as the 3 month, and then you have the 6 month paying 5.35%, etc. But these short term rates here, they're paying this much because of the fears that a debt ceiling is not going to get passed. The debt ceiling is going to get passed. It is going to get resolved. However, it is kind of stupid that we're the only developed country that uses a debt ceiling as a political football. It's really just an artificial limit that the party that's not in power, and both Democrats and Republicans do this, the party that's not in power use as a political football to get stuff that they want passed. But I do think that, these have to be taken advantage of. There is no reason why, cash shouldn't be sitting in treasuries right now, which is still, even with what's going on, considered the most risk-free asset on planet Earth. Obviously, you can do the same or similar with a money market or a CD account, even though there might be limits on the number you can deposit. Plus, only 250,000 is insured, whereas this is considered fully secure by the full faith and credit of the United States. Refer to that video on how to buy bonds, how to set up a bond ladder. It'll be worth your while. I'm obviously going to be day trading still. In terms of when I'm looking to buy stocks, as I said before, I sold stocks here in February, same level that we're at now. And I said that I should have bought when we retested that 3,800 level. I will fully admit that I should have been on the money. I should have really been on the lookout for buying back at that 3,800 level. The last time I bought stocks was back here in September, October. But I should have really eyed that 3,800 level. I don't care what happens to the market after this, even if it drops below 3,800. To me, 3,800 is a steal. So I'm looking at that. And then obviously I'm looking at the 2-year futures once again, especially as the debt ceiling uncertainty looms. I do think that we will see a rise in the 2-year futures. Again, I will send all of this stuff out in the academy. Make sure that you are signed up. Those monthlies are going to go away soon. Make sure that you are signed up so you don't miss any of my analysis, trades, investments, day trades, futures trades, options trades, etc. And I am also going to be doing a summer mentorship program where I will take a handful of you and walk you through how to trade, how to day trade, how to chart, how to do technical analysis. And I will personally make sure that every single one of you that is in this group, in this very small group, is that your progress is brought up to speed, right? So this is a summer mentorship program that I'm doing where you have to apply to it. Obviously, it's not free, but we're going to be selecting only 20 people from the group of thousands that we've up to this point have received thousands of inquiries on this. So make sure to put your name on the wait list. You will get sent an interview questionnaire, and then we will be selecting 20 people. So make sure you do that. Sign up to the monthlies. Again, leave a comment down below. Let me know, do you think we're going to hit a recession? Have we found a bottom? Is the worst yet to come? Are we going to have a much worse stock market? Are you a heavy bear here? Are you positioned short? I want to know the array of opinions. I want to know how you're positioned. I want to know what your expectations are and how you're navigating this. Leave it in the comment section below. I try to respond to each and every comment, I promise. Leave a thumbs up if you got anything out of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.